Hello and welcome to Commercial Real Estate Explained. This video is about 7 commercial real estate terms that you should know if you're thinking about investing in commercial real estate. Generally, this channel focuses a lot on helping business owners buy commercial real estate for their own use, but this specific video is going to be terms that are important for any investor to know, whether you're buying for your own business or whether you're buying purely as an investment and hoping somebody else is going to lease it. These are all terms that you should know. First and foremost, asking price. This is obvious. This is the price that the seller wants for the building. What's important to know about this is this isn't necessarily the price you have to pay. Clients will ask me, the asking price is this, is there wiggle room on that? Do I have to pay exactly that? Depends on your market, but generally speaking, the asking price on a commercial property doesn't necessarily have the same command that a residential property has. Right now in our current residential market, it is red hot, and a lot of times things are selling over the asking price. In commercial, there are much less people that are capable or willing to buy commercial real estate versus a home, and so you don't see things selling over asking quite as much. Generally speaking, the commercial market kind of trails the residential market, so we are seeing it heat up, but not to that level. So generally speaking, the asking price is sort of like what you'll see at a used car dealership where, that's what they would like. That's what they're willing to sign with you right now and move forward. But the reality is there's probably room for you to get a little bit better deal. That's where having a commercial real estate broker is very important. They're going to be able to run comps, do some analysis, and tell you if it's overpriced, underpriced, and they may be able to advise you of, hey, come in this low below the asking. What you want to avoid doing is going to the seller yourself and presenting some extreme lowball offer, because it's just going to undercut your credibility. It's going to make it very obvious that you don't know the market. And so that's why it's important to, understand, talk to a commercial real estate broker and get some expert help so you can know how much room there is on that asking price. Second is per square foot price. This is also obvious. Essentially, it is the asking price divided by the square footage of the commercial real estate. This is obviously really important. They talk about it in residential real estate, but I don't think it's quite as important as it is in commercial real estate. But essentially, you are looking at, on a per square foot basis, how much does this building cost? This allows you to compare a 500,000 square foot or a $500,000 building with a $1 million building, based on how big the buildings are. Once again, your commercial real estate broker will know, what's a fair per square foot price for a building in this type, in this submarket. It's a really quick way for them to say, whoa, this is overpriced, or whoa, this is a great deal. That per square foot price is a great thing to know. The next term you'll see often is sometimes things will be marketed with potential owner-user or owner-user building. What that essentially means is that the building either has significant vacancy right now, or it will have significant vacancy in the future. When they say owner-user or potential owner-user, what they mean is that it's not 100% leased long-term to tenants that are already in the building. So an owner-user, we've talked about it a lot on this channel, is a business owner that buys a building to use for their own business. So in order to buy a building to use for your own business, there has to be room for your business. So when something says owner-user, it means that there's significant vacancy either already, maybe it's 100% vacant, maybe it's 60% vacant, or there's only a year left on a tenant that's leasing the entire building and they don't have a renewal option. That's when you might see owner-user. And all that is telling business owners that they could potentially move their business in. From the other side, if you're a pure investor and you're not going to be moving your business in, you want to be careful of anything that says owner-user potential, because the inverse of that is, whatever tenant is in there is on a short term, or, maybe they're willing to relocate. And if I'm an investor looking for something that has long-term stability and a tenant that wants to be there for a long time, if it says owner-user on there, that means that there's some potential that the tenant's not going to be there, or it's already has significant vacancy. So keep an eye out for the word owner-user. The flip side of owner-user is what we call a leased investment. So if something is a leased investment, that means that there is a tenant in place that is paying rent and has usually a relatively long-term lease. So generally speaking, something is either an owner-user building or it's a leased investment. Sometimes you'll see them marketed both ways. Something can be a leased investment in that it's 100% leased, but there's only 9 months left on the lease. In reality, that's an owner-user building, but you want to understand the difference. Basically, a leased investment is really marketed towards an investor who wants to come and own the building, but isn't going to put their business in there. It's more of a traditional real estate investor that wants to buy the building and cash flow on the rent paid for by the tenant. So it's important when you look at any commercial real estate building, that's on the market, is it for an owner user or is it for a lease investment? And depending on what you're looking for, you can eliminate half of the buildings you're looking at based on just that criteria. That's going to save you a lot of time when you and your broker are underwriting buildings. Now, when you're looking at a leased investment, and this doesn't really apply to owner-user buildings, you want to think about the NOI, the net operating income. So essentially, this is the all of the revenue that the rent is paying, less all of the building expenses. So essentially, it is the net operating income. It's what's left after your building expenses. Now, the most important thing to keep in mind with NOI is before any sort of debt service, any kind of loan payment. So sometimes you'll see people, calculate cap rates. We'll talk about that in a second, and NOIs incorrectly because they factor in, how much the current owner is paying for their loan. That is obviously not correct. So what we're looking for is how much would this building cash flow if there was no loan on the building. That's essentially what NOI is. If you didn't have any debt, if you didn't have a loan to pay, how much would this building cash flow? Once again, the operating expenses to consider are your property taxes, your building insurance, your maintenance, your landscaping, any association dues, basically anything you would pay as an owner of the building. And you have to make sure you subtract that from the total rents in order to get your net operating income. NOI leads us to cap rate. Once again, cap rate should be an indicator that you're looking at a leased investment. Sometimes people will market owner-user buildings with a cap rate, and the reality is most buildings are one or the other. They're not usually both. There can be exceptions, but that's generally it. So the cap rate is just your net operating income divided by the asking price. So essentially, if you have $50,000 as your net operating income, and the building is asking $500,000, that's the asking price, your cap rate is 10%. Cap rate is short for capitalization rate. And once again, it's basically your cash flow without thinking about your loan expense divided by the purchase price. So that's the net operating income for the year divided by purchase price. That is your cap rate. Now, what's confusing is cap rates aren't necessarily set by anything. They're set by the market. Right now, for example, leased warehouses are extremely valuable. There's a lot of people that want to buy warehouses because of the pandemic. There's just been a lot of demand for people that want warehouses because there's so much e-commerce and people just feel like that's a safe place to put your money. Because more and more people are buying warehouses, the cap rate on warehouses have been pushed down by the market. Essentially, investors are willing to buy at lower and lower cap rates because they feel like warehouses are so valuable and it's such a safe place for them to put their money. So when you're a buyer, you want to have a high cap rate. Like the 10% cap rate we talked about is abnormally high. That's not something you're going to see normally. But that's a very good thing if you're a buyer. If you can buy something that's a 10% cap rate and it's not some kind of scam, then that's something that's interesting. On the flip side of that, if you wanted to buy a brand new leased warehouse, you're going to be more like a 4% cap. Now that's good for the seller, but as an investor, essentially, you're getting a 4% return on your total purchase price. And that's how to think about cap rates. It's a little bit confusing, but the more leased investments you look at and the more time you do the math with your commercial real estate broker, you'll start to understand how that gets calculated. One thing I wanted to point out is the seventh term to keep an eye on is pro forma cap rate. This is something that people come to me all the time and say, hey, this building is 100% vacant, but it's going to be an 8% cap. And essentially what that's saying is the price they want to sell it to you at once once you put all of the money and you lease it and you basically turn it into a viable asset, then the cap rate is going to be, say, 8%. So whenever you see the word pro forma before cap rate, definitely take that with a grain of salt, because they're saying, things have to go according to a plan in order to get to that cap rate. It's not the actual cap rate, which is what you want to keep more of an eye on when you're looking for a commercial real estate investment. So watch for the words pro forma cap rate and ask yourself what has to be done in order to actually achieve that cap rate. Oftentimes a pro forma cap rate is like, hey, if everything goes well and you lease to tenants at this rent, this is what the building's going to be worth. But you want to ask yourself, do I want to pay the stabilized price and then have to do all of the work in order to actually lease the building and get it to that level of performance? It's a little bit misleading. So make sure you keep an eye out for actual versus pro forma cap rates. Obviously, there is a lot to commercial real estate investing, but you don't have to be worried about it. It can seem daunting, but there's a lot of help out there. So make sure you find a commercial real estate broker you trust, whether you're a pure investor looking for a leased investment, or if you're a business owner that's looking to buy a building to occupy yourself, work with a broker, put a team around you, and that's really the best way to learn. So thank you so much for checking out this video. Here at Commercial Real Estate Explained, we help business owners make informed decisions about their commercial real estate. We put out about one video a week, so please hit subscribe, hit like. We really appreciate it. We're trying to get this information out to as many people as possible. Thank you so much for tuning in. I'm Dave with Carlson O'Connell Commercial Real Estate. Appreciate you watching the video, and have a good rest of your week.